Good morning. Let's get started with yet another accounting video in which we're going to look at the accounting cycle. The accounting cycle has various steps. So let's look at these steps and see which ones we're going to cover in the current chapter. So the accounting cycle starts with analyzing a business transaction. If we decide that this business transaction affects more than one account, then we call it an accounting event and we're going to record it in the journal. Once it gets recorded in the journal, that information will be transferred into the next book, which is called the ledger. That process is referred to as posting. At the end of an accounting period, we close all of those accounts to find the balances and we put it in the trial balance. That's as far as we'll go in the particular problem I'm going to go over right now for chapter 3. There are more steps in the accounting cycle. We'll visit those later on. So let's just look at these first 4 steps. Transaction analysis, it's a process of identifying the specific effects of economic events on the accounting equation. So I have an economic event. It may be a business event that doesn't actually qualify as an accounting event, which means it doesn't affect the accounting equation. So to recap, the accounting equation is assets equals liabilities plus stockholders' equity. In the expanded form, stockholders' equity is common stock and retained earnings. We saw that when we prepared our financial statements. Retained earnings comes from revenues minus expenses minus dividends for a period. That's how your retained earnings is going to grow. So if 2 or more accounts are affected by a business event, it's an accounting event and we need to journalize. Now, how are we going to put it in the journal? A journal is nothing but a collection of all the accounting events, the accounts that are affected. Did they increase or did they decrease? Now, let's take a quick example over here. Someone put in $10,000. They got common stock in exchange. Now, for the business, accounting is always done from the perspective of the business. Cash increased by $10,000. Common stock, which is equity, also increased by $10,000. Cash is an asset. Common stock is an equity account. So they are both balance sheet accounts. The balance sheet is affected. Your income statement is not affected because revenues and expenses were not affected. When an investor puts money into the business, we don't call that revenues. Revenues is from selling our goods and services. That's how we generate revenues. Cash flows. It affected our cash flows as in, I got cash that I'm the business, so it increased my cash balance. It's a cash inflow under financing activities. We'll look at that a little more later on. So now this information, how do I formalize it? I know which accounts are affected. I know whether they were increased or decreased. Now we've all heard this word debit and credit as it relates to accounting. Now let's see what it actually means in terms of what we're going to do over here. So in its simplest form, the the account is nothing but all information relating to an item. So let's say cash. All transactions that affect cash, when I put it together, it's called an account, the cash account. I have 2 sides for the account, the left-hand side and the right-hand side. The left-hand side for all accounts is called debit side. The right-hand side for all accounts is a credit side. Well, if I do the same for all accounts, it won't make any sense for the equation to be in balance. So let's remember this acronym DEAD, D-E-A-D. Rather morbid, but it's going to help us here in accounting. So what does this acronym DEAD tell us? We debit all expenses, assets, and dividends to increase these account balances. So let's take a look at what we have from our textbook over here. The basic accounting equation again, assets, liabilities, owner's equity. Owner's equity is expanded to common stock, retained earnings, revenues, expenses, and dividends. So let me take a look over here real quick. I'm going to look at these accounts now and see whether this acronym DEAD works or not. So I debit all expenses to increase them. So yep, to increase it, I debited it. Assets, to increase it, I debited. Yep, that worked too. And dividends, to increase it, Okay, so anytime these accounts increase, we're going to debit it. To decrease, I'll credit them, which means the opposite is going to be true for all these ones I did not mark. Liabilities, common stock, retained earnings, and revenues. To increase them, I credit, not debit, I credit them. To decrease, I debit them. So if I say an account is debited or an account is credited, you need to ask me what type of account was it to know whether it increased or decreased. Just a debit or a credit doesn't signify anything. Don't ever think that debit is good, credit is good or bad, or vice versa. It doesn't make sense. Okay. So with that, let's look at our journal, what that should look like. So a journal, again, is the first place where we officially start the accounting process. I always start with a date. Every journal entry must have a date. I have the account names, and I'll have the account that's debited and the account that's credited. So let's go back to our problem. And this problem, I'm going to work on the journal, ledger, and unadjusted trial balance. I'll get to that word unadjusted at the end of the problem. So here we have Ayala Architects that's incorporated as licensed architects on April 1st, 2022. During the first month of operations of the business, these events and transactions occurred. So they're telling us these events. Events basically mean it could be a business event that's not an accounting event as yet. Transactions always mean there's an outside party affected. So there are some outside parties that are affected. We have transacted with them. They've given us a whole list of transactions and events. They've told us the company uses the following account names, and we'll look at why we need this information. They've asked us to prepare the journal entry, journalize the transactions, and they say include explanations. I'm not going to do that just to save time. Post to the ledger, that's the T accounts, and then prepare the trial balance on April 30th, 2022. And they've given me 2 check figures. I'll look at that at the end of the problem. So let's first start with this journal. I have my column for date, my column for account name, then for debit and credit. With each transaction, I'm going to explain the accounting rules and accounting conventions. Rules are basically procedures that have to be followed. If you do not follow them, you made a mistake. Well, what's the consequence for you in my class? It's going to be marked wrong, you're going to lose points. And all of this that you see, the problem is going to flow through. As in, if you make a mistake in a journal entry, the mistake will follow into the ledger, it'll follow into the trial balance, etc. So pay close attention to rules. Conventions are the way we've always done it. This kind of makes life easy for accountants, and also for anyone else who's doing it on a routine basis, which is you right now for the semester. So on April 1st, the stockholders invested $18,000 cash in exchange for common stock of the corporation. All this is telling us is someone gave the business $18,000 and they said, we are now owners of your business. So the business they received $18,000. Their cash balance went up by $18,000. And they gave stocks, that is ownership, to the people who made the investment. So the very first thing I'm going to do is I'm going to put down the date. The date is April 1st. I'm going to identify the accounts that are affected in my business: cash and common stock. Cash is affected and common stock is affected. I'll tell you why I wrote cash first and then common stock. Cash is an asset. For the business, cash increased. Therefore, I debit cash. And common stock increased. I increase a common stock or an equity account with a credit. So let's see what the rules are. The rules are I must have date for every journal entry. Every journal entry must have at least one account debited and at least one account credited. That's an accounting rule. Total debits must be equal to total credits, and that's an accounting rule as well. These are the rules of your journal entry. Date, at least one account debit, one account credit, total debits must equal to total credits. What are some of the accounting conventions? I always list the accounts that I'm debiting first and then credit. So if I had written common stock credit, cash debit, that's not incorrect, but as accountants, it bothers us. So let's just try and do this. Debits first and then credits. Also, you will see the word that's the account that's credited. indented it. I put a little space and then wrote the word common stock. That's visually just to kind of let me know that I have credited the account that's credited is common stock. The next accounting convention would be I'd write a short explanation. I'm not doing it over here. Now, when you do this in the accounting software, whether it's QuickBooks, Peachtree, Quicken, any of these, it's going to force you to do the rules. So the rules are follow the rules. The rule is the date. Now, what a lot of softwares do is when you set it up, the wizard will say, should we auto-populate with the current date? So if I say yes, the date would automatically have been August 31st, 2019. It wouldn't give me a choice. It would put that date. So if you don't have auto-populate, then you need to enter the date. But it will stop you. It will not let you continue without a date. It won't let you continue if you don't have a debit and credit. And it won't let you continue if these numbers were not the exact same. That's if the total debits were not equal to total credits. So the computers kind of got you over there in that they're going to force you to follow the accounting rules. Okay, let's carry on. On the same day, we hired a secretary receptionist at a salary of $375 per week, payable monthly. This is a business event. I've entered into a contract. I've hired someone. They're going to work for me, and I'll pay them at the end of the month. We have agreed upon the salary. Right now, it is not an accounting event because it does not affect any accounts. The person has not worked as yet. Therefore, I don't owe them money as yet. They have to work before I owe them money. Now, in the accounting books, nothing is going to happen. Over here, I'm going to write the date and write no entry just to let you know that I did look at this. I did not overlook it. This is not an item I just missed. But in the if you were doing this for a business, you would not enter this in the accounting software at all. On April 2nd, you paid office rent for the month, $900. So I will write the date. I paid cash. Cash is going to be credited. Cash decreased. Why did I pay cash? I paid cash to the landlord so that I can use the office space for the next month. I'm going to get a benefit out of this. This benefit is called an expense. It's a cost of doing business. Rent expense. Again, remember the acronym DEAD. Debit all expenses, assets, and dividends to increase them. In this case, my asset decreased, so I credit it. My expense increased, so I debit it. On April 3rd, the next transaction, I purchased architectural supplies on account. On account means it's a credit transaction. I didn't pay cash right now. I'll pay it in the future. Typically, vendors will give you 30 to 90 days to make payments. They will send me a bill, and then I have to make my payment. So on this date, I still have a journal entry because the business did get something. What we got is an asset. The asset name is supplies. Now, I got assets worth $1,300. I didn't pay cash right now. Do I have to pay cash? Absolutely, yes. So I'm going to credit accounts payable. When you see the word payable, it's a liability. Now, over here, going back to this second business event, when we hired the secretary, I will pay the secretary, but right now, on April 1st, I said no entry because that person has not worked for me. I don't owe them anything as yet. Over here, the vendor has given me the goods. I owe them. That's why I have a liability in my books. The difference between those two transactions, on April 1st, I didn't get anything as yet from that individual. I didn't get the benefit of their service. Over here, I already received the benefit of acquiring that asset. Now, the next transaction on the 10th, I completed blueprints on a carport and billed my client. Okay, so what's happened on this date is April 10th, I have performed services, I have earned revenues. So service revenue will be credited for that $1,900. Now, if the client had paid me cash right now, I would debit cash, but they have not paid me, I have sent them a bill. They will pay me in future. In future, I will receive money for work I've already done. So the account I'm going to debit is an asset, accounts receivable. This indicates money is owed to me, that someone owes me the money. I have a right to collect that $1,900 from my client. On the 11th, I received $700 cash in advance from Jason to design a new house. So on this date, I have not done the work, so I cannot credit service revenue. But I did get the cash, so I'm going to debit cash. Well, do I need to credit something? Do I need to do anything over here? Absolutely, yes. What happens if I don't do the work? I'll need to return that $700. It's a liability in my books. In the ordinary course, I am not going to return the cash. What I'm going to do is I'm going to do the work. When I do the work in the future, I won't get paid again. Reason? Because I was already paid today. So at this point of time, I cannot call it service revenue. I'm not going to call it accounts payable because I'm not going to pay money. What I am going to call it is another liability, unearned service revenue, indicating I need to earn it, which means I need to do some work to make the $700 mine. On the 20th, I received $2,800 cash for services completed and delivered to Melbourne. So this is good. I did work, so I know it's service revenue. I've earned it. Unlike on the 11th, it's not unearned, it's earned. And I got the cash. So on the 10th, I did the work but didn't receive cash. On the 11th, I received cash, but I had not done the work as yet. On the 20th, I did the work and received cash. So 3 different types of situations we have over here. On the 30th, I now pay the secretary $1,500, $375 per week. The month is over. I got the benefit of that person's services, so I'm going to pay. Now, when I get the benefit of something such as a service from an employee, it's an expense for me. So I call it salaries and wages expense. I paid cash, cash decreased, so cash has to be credited. And the amount they've told me is $1,500. On the 30th, the monies that I owed the vendor, I paid $300. How much did I owe the vendor? Remember, I had a $1,300 purchase. I'm not paying all $1,300. I'm paying only $300 right now. So on this day, my journal entry is going to be cash credit because I'm paying cash. It's decreasing. Accounts payable is a liability. When I established the liability in my books, I credited it. I'm going to debit it in order to decrease it. So accounts payable debit to decrease the liability. So at this point, I've taken care of all my journal entries. I need to move on to the next step, which is posting to the T accounts. So let's see how I'm going to do that. Let me scroll over onto this side. Okay. So I have all my T accounts set up. Remember, a T account is nothing but basically 2 sides for each account. So I have cash, receivables, supplies, accounts payable, unearned service revenue, common stock, revenues, wages, salaries and wages expense, and rent expense. Now, if you notice the order in which I have placed them or grouped them, I have all my assets first, then my liabilities, then my common stock, which is the equity. I don't have retained earnings. Then I have revenues, and then I have my expenses. Makes things a lot easier if they are grouped in this fashion. And also, how did I know which accounts I need? Eventually, you will get used to it and you will know. For now, they gave me the account names, and they even gave it to me in the proper order in which I should be placing them. Makes life a little easier if I can do that. So with that, let me move on to the posting process. Now, I am doing what's called batch posting. Real-time posting would have been after each journal entry, I immediately post into the T account. I waited until the end of the month, and I'm doing it as a batch, all of them at the same time, okay? Both methods are acceptable, depends on the volume and your need in terms of how much information you need, what kind of information you need. So on April 1st, cash was debit, common stock was credit. So the $18,000, I bring it over onto the debit side of cash and $18,000 on the credit side of common stock. Rent expense debit, cash credit, rent expense debit on the debit side, cash credit on the credit side. And next item, supplies debit, accounts payable credit. So supplies on the debit side, accounts payable on the credit side. So I hope you're getting the hang of this. Accounts receivable debit, service revenue credit. So accounts receivable debit, service revenue credit. Then we have cash debit account, unearned service revenue credit. So cash debit, unearned service revenue credit. Then we have cash debit, service revenue credit. This is good. My cash balance keeps going up over here, and I'm earning revenues. Then I have salaries and wages expense debit, cash credit, salaries and wages expense debit, and cash credit. My cash balance has gone down, but obviously I got a benefit over there. And accounts payable debit, my accounts payable balance went down, which is good. A liability decreased, well, but so did cash, which is an asset. Okay. So now I have finished the process of posting everything from the journal into the ledger. That's the third step. First step was analyzing the business transactions. Second step was recording in the journal. Third step is posting into the ledger. Now that I have this, I'm ready to finish this step so I can move on to preparing the trial balance. So in the trial balance, what I have is all these accounts. I bring all the accounts that don't have a zero balance. I bring them over here. I list out all the account names. And I need to bring the balance, just the balance, okay? So you will see that in some cases, I have more than one debit or credit, or on both sides I have something. So let's start out with the easy one. If there's only one debit or credit in the account, that is the balance. So accounts receivable, I'm going to put a double underline under it. Supplies, unearned revenues, common stock, salaries and wages expense, and rent expense. These, there were only one debit or one credit, so that is the balance, okay? That leaves me with cash, accounts payable, and service revenue. Cash has debits and credits, so does accounts payable. Revenues has only credits, so I can just add these numbers up, and I can say my balance here is 4,700. That one is easy enough, okay? So now let's look at cash and accounts payable. Let's do accounts payable first, it's easier. There is one credit for 1,300, one debit for 300. Take the difference between the two numbers, which simply means subtract the smaller number from the larger number. 1,300 minus 300 is 1,000. Put that on the side that is larger. Okay, so I will put that amount over here. So the balance in my accounts payable account is $1,000 at the end of the month. I still owe $1,000. I'm not interested in all these details when I prepare the trial balance. I just want the balances in these accounts. For cash, I have 3 debits and 3 credits. So how do we proceed? You add up the debits and you add up the credits. So you add up the two sides. Okay, so I've added up each of these two sides. I have 21,500 and 2,700. Take the difference of the two sides, just like we did over here, and put the answer on the side that's larger. So 21,500 minus 2,700, the difference is 18,800. And I put it on the debit side because 21,500 is the larger of the two numbers. It was on the debit side. Now I'm ready to prepare my trial balance. Trial balance is a formal statement, which means your auditors will want to look at it. You need to have the name of the company, name of the statement. Trial balance, just like a balance sheet, is as of a particular date. So this is April 30th, 2022. I have the date over there. And now I'm going to write down all the balances. So cash, receivables, and supplies all have debit balances. They're assets. So I bring the numbers over here. I'm only interested in the balances. Accounts payable, unearned revenue, these are liabilities with credit balance, as is common stock and service revenue. Those are equity accounts. So bring them over here on the credit side. And then on the debit side, my expenses. I have 2 expenses over here. So I put those over here. Now, all that's left to be done over here is going to be adding up these columns. The debit column and the credit column. It should be the exact same number on both sides. If it's not the exact same number, we're in a lot of trouble. We made a mistake somewhere and we need to go back and look where the mistake was. Okay, so 24,400 on both sides, which means we are in good shape. All that's telling you is when you did your journal entries, your total debits were equal to total credits. Now, not that there isn't a chance that you could make mistakes subsequently. Common mistakes are transposing numbers. Instead of 1300, if I brought it as 3100, instead of 1900, if I brought it as 190, I didn't bring 10 in. That's the advantage when you do things on computers. As you may have noticed, I did very little typing after I did the journal entry. All my subsequent information, I was doing self-referencing to minimize all those mistakes. And I also use the formulas here in Excel. In the accounting software, you will just have to enter the date. When you enter the account name, you will have a drop-down button and you select the accounting because you already have all of that identified, and then you type in the amounts. So there's lesser room for mistake with accounting software. However, if I debit or credit the wrong accounts, that information will get carried over all the way through, and there is no room for me to make a correction unless I go back and identify where the problem was. So it's a lot easier when you're doing things manually, especially if it's a small problem. Okay, now we were given two check figures. Let's just make sure we are on the right track. Cash is 18,800 and total trial balance is 24,400. We confirmed that, but let's just go ahead and confirm our cash balance, whether it is the right number. And yes, it is 18,800. So once again, when you work on Wiley Plus, remember everyone is going to have different numbers, so you cannot copy information over blindly. Hopefully you understand the process. Again, to recap, when we worked on this problem, when we started this problem, we said that there are several steps in the accounting cycle. We analyze the business transaction, we journalize it if it's an accounting event. At the end of the period, post it into the ledgers, find out the balances in each account, and take that to the trial balance. I called it the unadjusted trial balance because after a trial balance is prepared, we need to do adjusting entries. That's something we're going to visit in the next chapter. So there are building blocks, and the first step always is analyzing a business transaction. You can't get away if you don't understand the basics of business and how it affects your accounting equation. So hopefully this has given you a good overview of chapter 3, and you're ready to prepare your record your journal entries, post into T accounts, and finally prepare your trial balance for the chapter 3 homework. Good luck with that.